Welcome to this explainer. Today we're diving into a genuinely shocking possibility. The idea of Meta dethroning Google as the undeniable king of digital ad revenue in 2026. Look, for years, the digital advertising landscape has essentially been a two-horse race, right? But it's been a race where Google has always comfortably held the lead. Well, that might be over. Recent data and forecasts are pointing to a historic reversal that is currently underway. We're going to look really closely at the numbers, the underlying technology, and the absolutely massive financial bets being placed right now that could permanently reshape how marketing budgets are spent.
Okay, so here's our roadmap for today. We'll start with the historic overtake projection, then break down the AI ad engine, look at Meta's massive infrastructure bet, talk about Threads hitting 500 million users, and finally, cover the new costs and realities marketers are facing. Let's dive in.
All right, Section 1, Historic Overtake Projection, the 2026 readout. Let's start with the headline that is literally sending shockwaves through the entire marketing world.
Get a load of this. These projections for 2026 mark the very first time analysts predict Meta will actually out-earn Google in worldwide digital ad revenue. We're talking eMarketer forecasting Meta reaching $243.46 billion, just edging out Google's $239.54 billion. Now, it's absolutely vital to frame this correctly. If we look back at the 2025 actuals, Google was still leading comfortably, but this projection, it's based on a massive divergence in momentum. Meta's growth rate is forecasted to accelerate past 24%, while Google kind of just holds steady around 12%.
Now, you might be wondering, are these just wild guesses? To understand why this forecast is actually credible, we have to look at Meta's audited Q1 2026 financial filings. Forecasts really only earn our trust when the most recent confirmed quarter is moving in the right direction. And these official SEC documents confirm Meta isn't just relying on hype, they are banking extraordinary real-world results. Here is the crucial point. Meta's confirmed Q1 ad revenue grew a staggering 33% year over year. That's $55 billion. They are growing roughly twice as fast as Google's 15.5% growth in that exact same period. Let that sink in. This isn't just some slight edge. This is an established tech giant completely hitting the gas pedal. This 33% surge is the very foundation that makes that 2026 overtake projection look less like a pipe dream and way more like an impending reality.
So, Section 2, the AI ad engine, powering Meta's growth. Let's see how this builds into the core engine that's actually driving Meta's explosive performance.
Enter GEM, the Generative Ads Recommendation Model. This is Meta's AI ranking architecture, and it is doing the heavy lifting here by ranking ads with just unprecedented efficiency. Now, caveat, it's important to note this 4x more efficient claim comes directly from Meta themselves, but still, the real-world impact is undeniable. While older systems required advertisers to painstakingly manually define their audiences, GEM completely flips the script. It works by analyzing the creative content you upload, and then the AI autonomously goes out and finds the users most likely to engage. It's a total inversion of the traditional campaign setup.
It's kind of like a highly coordinated team. These three AI layers work together to flip that traditional advertising model. And get this, a whopping 8 million advertisers are already using these AI creative tools. That is literally double the adoption from just 4 months prior. Here's how the whole shebang operates. First, you have Andromeda, which acts as the personalized retrieval engine identifying potential users. Then, GEM steps in to actually rank those users. Finally, Manus, a newly integrated AI agent, sits right in the ads manager providing plain English performance queries and competitor research. It's a true end-to-end AI workflow, and it is a massive game changer, especially for small and medium-sized businesses.
And this slide brilliantly illustrates genuine pricing power. Look at this. Meta isn't just serving more ads, they are literally charging more for them because the AI is driving real tangible conversions. When your ad impressions go up by 19%, and the average price per ad goes up by 12% in the exact same quarter, that is the ultimate signal of advertiser demand. It proves marketers aren't just buying up cheap volume. They are willingly paying a premium because the AI is actually delivering a better return on their ad spend.
Moving on to Section 3, the massive infrastructure bet, building the future. Because building this AI machine takes a mind-boggling amount of hardware and cash.
As Mark Zuckerberg put it, I'm looking forward to advancing personal superintelligence for people around the world in 2026. His vision for this personal superintelligence is pushing the entire company to aggressively scale their physical compute infrastructure. This isn't just about showing you better ads on Instagram anymore. Meta is deploying their Muse family of models and rolling out AI glasses that act as all-day personal assistants. They are actively aiming to be the foundational layer for AI in our daily lives. And to do that, They need data centers on a scale we have rarely ever seen.
Which brings us to this astronomical number, $125 to $145 billion. That is Meta's revised 2026 capital expenditure guidance. It is a massive financial bet entirely focused on AI data centers and custom silicon chips. They literally stepped up their contractual commitments by over $100 billion in a single quarter. Now, this is the ultimate double-edged sword for investors, right? It's the fuel funding their massive AI leads, sure, but if revenue growth ever stalls, this immense spending is going to create some immediate, heavy margin pressure.
All right, Section 4. Threads reaches 500 million, the social comeback. Let's pivot to the consumer social side for a second, where Meta's text-based app Threads is pulling off a historic comeback.
$500 million. Threads just hit 500 million monthly active users. This is a milestone they achieved incredibly fast by allowing people to easily port their existing Instagram identities right over. That move was genius because it eliminated the infamous cold start problem that kills almost every single new social network. They added a staggering 100 million users in roughly 10 months, proving that this isn't just a passing fad, it is a firmly established platform with a highly educated and affluent user base.
And to put that growth into perspective, while X still wins out on desktop, Threads has actually overtaken X on mobile daily active users, 141.5 million for Threads versus 125 million for X. Plus, Threads is boasting a much higher creator engagement rate at 4.51%. Compared to X's 2.31%, it's clear Threads is actively rewarding conversational, genuine content. For creators and B2C brands watching this explainer, this represents a massive, largely untapped organic opportunity, where your content actually gets seen and interacted with by a highly active community.
Let's wrap up with Section 5, New Costs and Realities, the EU fees and Google's risk. Because it's absolutely crucial we do a reality check on the new costs and structural risks marketers have to navigate moving forward.
Marketers, listen up and maybe take a screenshot of this slide. Starting July 1, you must bake these unavoidable digital services tax location fees directly into your European ad budgets. Meta is no longer absorbing these costs. For example, if you run a $100,000 net media campaign in France, it's now going to cost you $103,000. In Austria, $105,000. And there is absolutely no opt-out. You have to re-baseline your market-level budgets right now. Otherwise, you're going to quietly lose 2 to 5% of your total reach in these specific regions.
Meanwhile, we need to talk about Google because they are facing a slow-moving structural risk. As their AI provides direct answers to users, less traffic is flowing out to the open web, which is actively shrinking their AdSense publisher network. Now, it's important to note Google's core search business is still super healthy. It grew 19%, but their network revenue dropped by 4% to $6.97 billion. Users are just getting their answers directly from Google's AI overviews without ever clicking through to websites, and that actively hollows out the independent publishers that Google relies on for its wider ad distribution.
So as you adjust your media plans based on this explainer, you really have to ask yourself a tough question. In an AI-first world, is the open web dying? And is Meta holding the only winning hand? It's a profound shift in the industry. Automated, AI-ranked advertising is heavily consolidating spend toward whichever platform makes performance the easiest to scale. And right now, based on breadth of adoption and pure raw momentum, Meta is leading that charge. Thank you so much for joining me for this explainer, and I highly encourage you to keep a very close eye on these shifting tides as we move deeper into the year.